Welcome back to Investing Talk Podcast. Today, we're taking a closer look at a key player in China's digital infrastructure, GDS Holdings. Now, based on the material you shared, GDS is a leading company. They build and run these high-performance data centers. And they're not just any data centers, they're carrier neutral, which means, they connect to lots of different networks. Plus, they're set up in China's big economic hubs.
Right, strategically located.
And they mostly serve the big cloud providers and large enterprises. They offer colocation, managed hosting, basically the critical space and connections needed for cloud computing in China.
That's a good way to put it. They really are providing a crucial backbone for the digital economy there.
Okay, so our mission here is to sort of unpack the insights from the material you've given us. We want to understand GDS Holdings' current financial picture, its industry standing, recent strategic moves.
And just the general outlook for the company, right? As of now, mid-June 2025.
Exactly.
Okay, we'll walk through the key findings, try to connect the dots for you.
Great. And before we get into the thick of it, if you're finding this exploration valuable, please take just a second to subscribe, like, and maybe leave us a comment. It genuinely helps the show.
It really does.
And if you feel like supporting us a bit more, you could consider buying us a coffee. We'd really appreciate that support. All right, let's dive in. Let's start with the financials. What's the story the numbers are telling us about GDS's performance, its growth?
Well, the information shows that GDS is still growing its revenue. If we look at Q1 2025, net revenue hit RMB 2,723.2 million. That's about US $375.3 million.
Okay.
And that's up 12% compared to the same time last year. So growth is there.
Yeah.
Historically, they've had solid double-digit growth, though the material suggests the pace maybe isn't quite what it was in earlier years, when it was sometimes over 20%.
Got it. So revenue's climbing 12% year over year, still pretty decent. But what about actually making money? The bottom line, are they profitable?
This is where things get, let's say, more complex. It's a really critical point in the material.
Yeah.
GDS has had persistent net losses, negative earnings per share, too. So no, at the net income level, they remain unprofitable.
Okay, why?
The main reason given is the sheer amount they're investing in new data center capacity. I mean, they're building a lot, and those expansion costs are, for now at least, running ahead of the revenue growth.
Right, that makes sense for this kind of business. Build it and they will come, but building costs money up front. Huge amounts, I imagine, for data centers.
Oh, definitely. Highly capital intensive.
So if they're not profitable yet, how are they funding all this? What does the debt situation look like?
That's a major focus. The material highlights high leverage. Their debt-to-equity ratio, it's reported around 140.8%.
140%, wow.
Yeah. So for every dollar of equity, they've got about $1.48 in debt. The information flags this as high for the sector, signals, increased financial risk. We're talking total debt around CN 34.4 billion against shareholder equity of about CN 24.4 billion.
Okay, that is a significant amount of debt relative to the equity base. What does that mean practically, like for their ability to handle interest payments, especially if they aren't generating net income?
It means quite a bit. That high leverage is called out as a key concern. It exposes them to risks. Things like refinancing risk, what if credit tightens, or interest rates go up when they need to roll over debt.
Right.
And their ability to cover interest payments, well, the interest coverage ratio is noted as only about 0.7 times.
0.7, so less than 1.
Correct. Their operating profit currently covers only about 70% of their interest expenses. That suggests vulnerability if cash flows weaken. And given the high spending on expansion and the debt load, it's likely their free cash flow has been tight, maybe negative. Return on equity also probably low because of the losses and the leverage.
Okay, so the financial story is strong growth on the top line, yes, but it's fueled by heavy investment leading to ongoing losses and a really substantial debt burden. Growth at a cost, you could say.
That sums it up well. That tension is central to understanding their current situation.
Let's move beyond the pure numbers then. What about GDS's position in the market? What are their strengths? What makes them a major player despite these financial pressures?
The material points to several core strengths. First, they operate large-scale, carrier-neutral facilities. That model is attractive. Second, setting up data centers in China isn't easy. High barriers to entry regulations, the sheer capital needed. That protects them somewhat.
Okay.
Third, they've built strong relationships over time with the big cloud companies and major enterprises. These are their key customers.
Sticky relationships, presumably?
You'd think so. Plus, their geographic presence in China's main economic zones is a big plus. and running multiple hyperscale sites gives them efficiencies of scale. They're seen as a leading independent provider in a fast-growing market.
Okay, strong operations, good customer base. What's actually driving the demand in that market? Why is it growing so fast?
Well, the fundamental drivers are pretty powerful. You've got rising demand for cloud computing generally from Chinese tech giants and just businesses digitizing everything.
Yeah.
But the material also specifically highlights their exposure to the surge in AI-related demand.
Ah, the AI factor.
Yes, AI needs huge amounts of computing power, and that power lives in data centers like the ones GDS operates. This is seen as a key potential driver for future growth.
That AI angle seems really important for their long-term story. Who are they actually competing against? Is it crowded?
They compete against other domestic players, Data Group is mentioned, and also global operators who are expanding in the Asia-Pacific region. The material gives a bit of a comparison. It positions GDS as having high revenue growth, but, as we discussed, negative profitability and high leverage. This is contrasted with Data, described as having more moderate growth, but maybe slightly positive profit and lower debt. And then global players like Equinix usually show moderate growth, positive profits, and lower leverage too.
That comparison really underscores their particular strategy, doesn't it? Go for growth, use leverage, accept losses for now, whereas some peers might be more balanced.
It does seem to be a different approach, yes.
What about industry risks beyond the financial ones? Regulatory environment, competition.
Yeah, those are mentioned. Regulatory scrutiny on tech infrastructure in China is always a background factor. Intensifying competition could lead to pricing pressure down the line. That's a potential risk. And of course, the high capital expenditure needed just to stay in the game. That's an ongoing challenge.
Okay, let's shift to recent events. The material mentions some strategic moves in 2025. What's GDS been up to lately?
Yes, a couple of notable things this year. Back in May, GDS did a U.S. $550 million offering of convertible senior notes.
Okay, convertible debt.
Right, often used to raise cash. Likely aimed at boosting their liquidity or funding more growth, given the spending needs we talked about.
Makes sense. What else?
Then in March, they did something apparently new for them in China. They monetized some data center assets, sold them to a private REIT.
Selling actual data centers to a real estate investment trust. Interesting.
Yes, it's described as an important step, a way to potentially unlock the value tied up in those physical buildings and, improve their balance sheet flexibility, maybe without just piling on more traditional debt.
That's a clever way to raise cash, potentially. Does this asset sale tie into any bigger plans?
It seems so. The material mentions ongoing talks about maybe launching a larger China REIT, seeded with more of their mature data centers. And there was also that earlier move for their Southeast Asia business, Daeon. They deconsolidated it, sold down their stake to 38%.
Right, remember that.
That raised capital too, but it also reduced their direct exposure to international growth there. And there's talk of maybe an IPO or spin-off for the rest of that Daeon stake later, if the market's right.
So it sounds like they're actively pulling different levers, debt, asset sales, restructuring to manage their finances and fund growth. Looking forward, what are the potential catalysts or risks highlighted?
Upside catalysts mentioned include a successful day one IPO or spin-off, or launching that China REIT successfully. Either could unlock value or really help the balance sheet.
Okay.
On the risk side, potential dilution from those convertible notes if they convert to stock.
Always a risk with converts.
Yep. Ongoing regulatory risks in China, that's still there. And broader economic stuff like a slowdown in the property sector, or if companies cut back on IT spending, that could hurt demand.
So how's the market taking all this? What's the general feeling or sentiment?
The material suggests it's kind of cautious optimism. Analysts see the upside, especially from AI, but they're definitely wary of the balance sheet risks, the debt, the losses.
Understandable.
The stock price has been volatile, apparently trending sideways more recently. It seems pulled between the potential from these strategic deals and the underlying financial concerns. Social media sentiment, described as mixed to positive. People see the long-term trends, digital transformation, AI, but they also worry about the debt and regulations.
Right.
Okay, let's try to bring it all together, though.
Yeah.
Based on everything we've discussed from the material you shared, what's the summary picture, the main takeaway on GDS Holdings right now?
The summary recommendation provided is basically hold.
Hold. Okay.
Why? The thinking is, while GDS is clearly benefiting from huge trends like AI and cloud, and they have a strong market position, the persistent losses and that really high leverage just temper the enthusiasm for being more aggressive right now. Those near-term moves, like selling assets, offer potential upside and flexibility, sure, but they aren't a guaranteed fix for the bigger financial structure issues, at least not immediately. So the suggestion is investors should probably watch closely for real progress on profitability and getting that debt down before maybe upgrading their view.
Okay, so GDS Holdings seems like a really interesting, maybe even classic case study. You've got a company riding these powerful waves, AI, cloud, in a key market with high barriers, but it's grappling with the financial reality of that aggressive expansion, high debt, no profits yet. It really does capture that growth versus profitability challenge, especially for infrastructure companies. Building the future takes a lot of capital and carries risk today.
So thinking about this and looking at the data center sector through the lens of this material, what's a key question this whole situation raises for you? Something for us and you, the listener, to ponder.
Well, it definitely makes you ask, in a business that just eats capital like data centers do, how sustainable is that strategy? Relying on very high leverage, accepting ongoing losses, even with strong revenue growth, and clever moves like asset monetization. How long can that continue, and what needs to happen for it to ultimately succeed?
That is a really potent question to chew on. How sustainable is that model in the long run? Thank you for sharing the material and walking us through this analysis. Really appreciate you being here.